Good morning, everyone, and welcome to our DAT IQ Weekly Market Update. I'm Ken Adamo, Chief of Analytics at DAT, joined by Dean Croak, who's our Principal Industry Analyst, and Ned Damon, who's our Principal Data Scientist. Welcome, guys.
Howdy.
How are things going? I mean, we kind of got, it's one of our key points of the week, spoiler alert, but we kind of got different things going on in the different parts of the countries that we're located in, right? There's that huge fire out in Oregon and rain and flooding out east. How's everyone holding up?
I mean, the fire's in the southern part of Oregon, so it's not in our neck of the woods right yet, hopefully.
I mean, as an average American, I'm just going to lump all of Oregon in with what I hear on the news in a 5-second clip.
We've got both the humidifiers running at full speed downstairs. We're pulling out about 10 gallons a day out of the basement in condensation. It's just for July, it's unbelievable the amount of humidity in the northeast.
Yeah, it's crazy. We actually have smokes, like haze setting in from Canadian wildfires, I guess. Some lady at the coffee shop told me that this morning. I don't understand. I'm living in a world I don't understand. So for those not familiar, this isn't a weather program. This is a freight talk and freight analytics program. We're here every Tuesday at 10 a.m. Eastern, 7 a.m. Pacific, talking about trends in the freight market, what we're seeing, how to prepare for future market changes, but most importantly, answering your questions. So if you have any questions, please feel free to drop them in the chat or comment section. We have a team of marketing folks who get those over to us, and we walk through them at the end of the show. I also want to, before I forget, plug a couple things. We have Freightvine Podcast. That's Dr. Chris Kaplis, sits down with luminaries in the freight market, mainly on the shipper side, talking about end-to-end logistics, trucking, supply chain, things like that. Our very own Dean Croak will also be on, help me out, Dean. You're going to be on the Dave Nemo show for sure this Thursday.
Yeah, Thursday, 8 a.m. and on the Rates and Lanes podcast tonight on Blog Talk Radio at 7 p.m. Eastern tonight.
If you haven't checked out that Rates and Lanes thing, it's really good. I would recommend. That's a good use of time. That's one I wouldn't even recommend watching it like 1 1/4 or 1.5 speed. You'll miss all of the good information that they discuss. But so with that, I'm going to pivot us to our key points of the week. So as expected, things are slowing down a bit post 4th of July. Now's that time period for all three major equipment types that we're going to be very closely watching how analogous this year is to 2018, where things seemingly fell off a cliff in the second half of the year. So it wasn't a huge impact due to the driver safety week, but we are expecting brake check week or brake safety week in August to be a bit different. And then lastly, as I mentioned earlier, localized weather and other issues happening around the country, trucks running into bridges reopening, all kind of things going on, which Dean's going to cover here in a minute. So with that, I will turn it over to Dean to walk us through our market update this week. Dean?
Yeah, thanks, Ken. I'll add a little bit more color to the Driver Safety Week piece. One of the things that's different between Road Check Week, Driver Safety Week, and Brake Check Week coming up in August is the Road Check and Brake Safety Weeks are really static inspections. So they're a lot more visible. They take a lot more time, whereas last week's Driver Safety Week was more about mobile vigilance on speeding vehicles. So we didn't see any impact on capacity last week, but I think the upcoming August Brake Safety Week will mirror the capacity crunch we saw during the International Road Check Week at the start of May. All right, so jumping into our load board activity on the dry van side, dry van load post volumes bounced back last week, increasing by about 8%. Volumes are about 26% higher than this time last year. But last week, capacity did ease. There was a 19% week-over-week increase in equipment posts. And that higher number had the net effect of decreasing the dry van load-to-truck ratio to 5.54. On the refrigerated side, the load-to-truck ratio, volumes increased slightly last week, only up by 3%. But they're up by about the same amount month over month due to the July 4 surge we saw. Capacity ease, there was about 14% more equipment posts last week, so the refrigerated load-to-truck ratio decreased by about 9% to 11.52. And in flatbed, just like they did in the second week after July 4 in 2018, flatbed load post volume surged last week, increasing by 21%. In 2018, they started to decline after this week. So we'll talk about that a little bit later in the show. Capacity also eased in flatbed. There was a 28% week-over-week increase in equipment posts. As a result, the load-to-truck ratio dropped to 41.82. That's the 9th, going on the 10th week in a row that the load-to-truck ratio has been decreasing. So taking a look at our heat maps and the dry van market condition index, a little bit of focus on the West Coast this week. E-commerce volumes are up in Stockton, which is a large e-commerce import market where a lot of freight is warehoused. The lane that we're looking at today is Los Angeles to Portland. Stockton to Portland. It hit a 12-month high last week, reaching $4.17 a mile. That's up an amazing $1.37 a mile since February. That's Los Angeles to Stockton, and Stockton up to Portland. On the Los Angeles to Stockton run, which is where the freight sort of arrives in Stockton from Los Angeles on the port side, it's one of the highest freight volume lanes in the country. Spot rates are even higher than the Stockton-Portland lane. They're up to $4.27 a mile this week. That's excluding fuel. Loads east from Los Angeles to Phoenix continue to climb. They hit another 12-month high this week of $4.46 a mile. That's 29 cents a mile higher than the $4.17 mile peak we saw last October when imports were surging from Asia, so up to $4.46 this week, Los Angeles to Phoenix. Having a quick look at the East Coast, another large warehouse market is Allentown, Pennsylvania. On the run to Richmond, Virginia, rate spiked last week, jumped almost 60 cents a mile to $4.23. That's after they've been sitting around $3.65 a mile for the last 9 months. Having a look at the refrigerated market condition index, a lot of you would like to know that it's a beer week in Omaha this week. There's more than 50 different breweries, beer bars, restaurants, all celebrating the industry. Inbound reefer rates were up from the second highest state, which is Denver, the second highest state for breweries. Rates are up 25 cents a mile into Omaha. They were up to $1.94 a mile. From Chicago to Atlanta, reefer rates surged last week by 31 cents a mile, up to $3.71, excluding fuel. North in Green Bay, reefer rates to Minneapolis spiked 54 cents a mile last week to $3.34. That's significant. They've only been averaging $2.70 a mile since last November. And in the Deep South in Florida, where produce season is in the revision mirror, reefer rates from Lakeland to Baltimore cooled off rapidly, dropped almost $1 a mile since the peak in May. They're down to $2.26. Those of you that watch the show will remember during the peak in May, during peak produce season, in Florida, they were up to $3.23 a mile, so down almost $1 to $2.26 a mile this week in Florida. Having a look at the flatbed market condition index on the 300-mile run to Memphis from Houston, I think it is, we're looking at here. Rates are up to $4.36 a mile. Capacity's tightening also in other directions out of Houston. Number one flatbed market, which is Houston in terms of volume, spot rates to Bismarck, North Dakota surged last week. They were up 52 cents a mile to reach an average of $3.25. And on the number one flatbed lane from Houston to Lubbock in the Permian Basin, flatbed rates dropped slightly last week, decreasing by 4 cents a mile to $3.31. So wrapping up this week's market update with a quick look at our year-over-year spot rates. In dry van, spot rates exhibited even more seasonality last week, decreasing slightly by 1 cent per mile to an average of $2.42. That's 2 weeks in a row spot rates have been sliding, but still nowhere the rate of decline we'd normally expect to see in the weeks immediately after July 4. Spot rates are still 25% higher, or about 70 cents a mile higher than this time last year. In refrigerated, the year-over-year view shows that rates dropped about 5 cents a mile last week. They dropped dropped 5 cents a mile the week before. It dropped another 2 cents a mile last week to an average of $2.76. Like dry vans, still 26% higher than this time last year, about 70 cents a mile higher, and also about 24 cents a mile higher than this time in 2018. And lastly, in flatbed, after dropping by 2 cents a mile the week prior, flatbed rates dropped another 3 cents a mile last week to an average of $2.70. Definitely some cooling going on in that market. Flatbed appears to be tracking very closely with 2018 when there was a significant flatbed rate rally. Rates did turn south in 2018 in July. They're still about 70 cents a mile higher than this week last year, 24 cents a mile higher than this time in 2018. But there is some signs that rates are starting to cool off in there. Interestingly, spot rates dipped under contract rates in the last week by about 14 cents a mile. That's the first time they've been under contract since April. So that's it for this week's market update. If you'd like to find out more about what's going on in the freight market, go to dat.com/market update and download our weekly blog post. Over to you, Ned, for the short-term forecast.
Howdy, everybody. We're going to be starting off with our van forecast. So if you look at the chart, in blue, we have the market rates observed by DAT, and then off to the right, we have our different models. Right now, it's really hard to tell them apart because there's a lot of model agreement, which in general means that I feel like something is going right in the modeling department if all the models are lining up, but we'll see how it shakes out. In red, if you can make out that line, there's our short-term model. In blue is our flagship ratecast model, and in gold and silver are our two blended forecasts, which are mixtures of the two models in different amounts and in different ways. Here, they're all the models are basically in agreement. There's a little bit of disagreement about exactly how the bumping is going to be going forward, but more or less rates holding steady, moving in through the middle part of August. Moving forward to reefer, you can see once again in blue the market rate observed by DAT, and then here there's a little bit more model divergence, with the short term in red expecting there to be weekly patterns, but those weekly patterns generally have an upward tilt to them, maybe by about 2-3 cents a mile. Over all the basket of lanes that we look at. And then ratecast and the two blended forecasts in respectively blue, gold, and silver are all expecting rates to stay more or less where they are, with maybe a little bit of a dip of about a penny a mile. Finally, moving into flatbed. Here, there's, again, wide model agreement, but a little bit of difference over the particulars. Once more, in blue are the market rates observed by DAT. In green is the ratecast model, which is expecting flattening with a little bit of dropping, heading into maybe about 5 cents a mile-ish, sliding by the middle of August. The short-term model is a little more bearish, expecting things to be heading down right away, and the blended forecasts are leaning more in the direction of the short-term model going forward. And that is it for our rate discussion. And now we're on to the IQ question of the week. If I can pull up the text on that. Sorry, this is my bad. I thought I had it up, but I don't.
You need to phone a friend here? I have it up.
Yeah, no, you have it up? Okay, pull it up, please.
Will rising costs and depleted inventories be a drag on the flatbed market this fall? Dean, I think that one is tailor-made for your expertise.
Yeah, it's a difficult one. I think the answer is yes. I think volumes are definitely cooling off in the flatbed market. They typically do this time of the year. The only caveat there is, of course, hurricane season. That impacts a lot of flatbed activity, particularly in the southeast, where a lot of single-family homes are built. So that generally can tighten capacity pretty quickly and increase demand depending on the severity of the hurricane season. There is a lot of inventory stocking going on. It's taking a while for those retail prices to reflect the lower lumber future prices. So we're still seeing high retail prices on the cost side, but I think that'll take 2 to 3 months for those to come down, according to some of the experts that have been analysing the lumber market. I just think that as it just looks like. This year looks very much like 2018. There's definitely a peak in activity during the early spring, summer period when people are building and digging holes and doing construction, all sorts of activity. That definitely tapers off towards the end of the year. So I think it will. I think volumes will fall off this fall.
Do we have the housing starts chart that we can pull to talk to that?
Sure. Yeah, I can, if you want to throw that up, I can just talk to some of the numbers there from this morning's release. Yeah. So charts you've got up in front of you now, this is sort of what we wanted to talk about today was the remarkable similarity between the 2 years, 2018 versus 2021. On the left, you can see our load post volumes, almost identical to 2018 in light blue. The red line is this year. You can see equipment post down the bottom, tracking along, although at a little bit higher level. And then you can see the load to truck ratio. It's almost identical in terms of how it's works throughout the year. And one of the things we've been looking at is why is it? Because they've been two very different economies. This year it's a consumer-driven economy. 2018 was an industrial-driven economy. We had changes in the tax code. We had oil price rallying. We had some hangover effects from the two big hurricanes. I think it was Irma and the other name escapes me in late 17. Harvey, of course. We had a lot of activity in the drilling industry. That was really the big reason why spot rates increased so much in flatbed in that particular period. I looked at our rates this morning historically, and in the first half of 2018, flatbed rates increased by 43 cents a mile in the first half of 2018. So they're up 22%. And that was more than triple the rate increase for dry van and reefer. So 2018 was really about flatbed. It was driven a lot by, I think, when I looked at the Federal Reserve economic data from the Fed in St. Louis, the FRED database, it shows that the mining, quarrying, oil and gas sector, those were the data points that really drove the flatbed market in 2018. The similarities, it's more coincidental. It's just two big events happening at the same time of the year. In 2018, we had some strong industrial economy activity. This year, though, we had the polar vortex, which happened in late February, and that hangover effect of the disruption in the market took quite a few weeks for it to work out. So the two things are very different in terms of what drove them. It's just that the charts look almost identical when you look at them year over year.
I mean, not to poke too deeply into that, Dean, but you're saying that a significant fraction of the rally in the early part of the year from flatbed was driven by the polar vortex effects. Is that your conceit, or just like 10%? I'm just trying to get like an estimate. If you had to assign like 100 percentage points between things.
Right.
That's a good question.
Yeah, I'm not sure, Ned. I think it was just that the fact that capacity was already tight. Right. And it completely disrupted all of the freight markets, but it also disrupted a big part of the freight market in the southeast and the south. Whereas, there's some of our biggest flatbed markets in Texas. You've got, I think it's something like 60% of oil production comes out of those two big basins in Texas. So we see a lot of flatbed activity. Our number one volume lane was Houston to Lubbock. I think it was a huge part of why we saw the market, the capacity crunch, was the polar vortex, in particular in the southeast.
Yeah, and I mean, it kind of bears out if you look at the graph of rather than the load post, the equipment posts were kind of flat to declining, if I'm reading this chart right, in the early part of the year. And it was made up for by an overabundance of load posts to get that same shape. Yep.
I mean, the 2018 market really, when you go back and look at it, for those that studied the market, the real story for 2018's rate rally began in the middle of 2017. And that was because there was a lot of drilling activity. So there were a lot of wells being drilled. The number of rigs drilling for oil in 2017 to June 2018, that 1 year period, jumped by 50%. Oil price jumped from $45 a barrel to $71 a barrel. So there's a lot of drilling, a lot of activity, a lot of flatbed work with drill pipe casing, all sorts of things going out into the Permian Basin. But the difference this time around is that a lot of those wells were drilled and not fracked. So there's a big difference in the two. We had a lot of investment in drilling activity in the 17-18 period. That hasn't happened this time around. So that's why you're seeing oil production levels differ this time, because they've already drilled the wells before they started fracking them this time around.
Makes sense. Not to pivot, but I think flatbed is going to resemble 18 a lot more first half, second half than reefer or dry van, right? Because the big difference there was the absolute flood of capacity in the market into the second half of 18 for dry van and reefer. And we're just not seeing that, right? Those orders aren't manifesting into power units and butts and seats.
Right. We're just not seeing. I mean, manufacturing output was probably the best one that I looked at in terms of production numbers. There was an uptick in 2018, but it stalled in the second half of 18, turned downwards in 2019. So we saw a sharp rebound in the first half of this year, but on a seasonally adjusted basis, the increase in output has started to slow down. So even on the manufacturing side, on the heavy machinery, we're seeing those numbers start to taper off back below pre-pandemic levels. So we just haven't seen the demand there yet. Hence my earlier statement that I think flatbed volumes will start to decline as the year progresses.
Yeah, I agree with you. I was having a really good conversation with Bill Cassidy at JOC yesterday, and I think really that's going to be what's going to differentiate 18 from 21 is the timing of when that capacity is going to hit the road. I mean, we're sitting over 400,000 power units ordered in a trailing 12 months window. Probably half of those haven't been delivered yet, right? And nothing that's ordered now is going to hit in 21. So
that's next year. Before, yeah. But the other thing I looked at in building industry, and one of the stars of the economic recovery in the last year has been the building and construction industry.
Tell me about it.
Yeah, I look at the building permit applications. They're a leading indicator of housing starts. They lead by about 1 to 2 months. Permits dropped only by about 1% in June. But anytime you start to see permits drop, that's an indicator that building activity starts to slow. Now, I know 1 month doesn't make a trend, but it's important to watch things like building permits. We've heard lots of activity from the building industry about how they've been suffering from higher building costs and have been pulling back on building homes because of the escalating building costs they've been having to deal with, especially those with fixed price contracts.
Right.
Yeah, I mean, it's actually getting to a point where high prices at a certain point stifle growth. So I think with the building materials in particular, you're starting to see those high costs and inventory scarcity actually starting to hamper growth for sure.
Right. Yep.
I wanted to ask a quick question. So you guys were suggesting that we might expect flatbed prices to slide as we head following the 18 curve as we head into the tail end of the year, but reefer and van prices to stay high. What percentage, Dean, in your experience, of flatbed drivers would be willing to drive a different equipment type to take advantage of a rate differential? I mean, I know it's not going to be as much, but theoretically, you could see some shift into increased capacity through that.
Yeah, 100%. If you've been stuck under a crane for 8 or 9 hours trying to get loaded, you have some pretty bad days in flatbed, especially when it's cold and wet. So there'll be a lot of guys looking for dry vans and reefers in winter. But volumes do slow down, so you do see a migration of drivers over to those other equipment types in winter anyway.
Right.
Flatbed's such a specialised sector. You've really, it's not a place for students necessarily. You've got to be experienced. You've got to know what you're doing. It's not just about driving the truck. You've got to be able to tie that load on so it doesn't fall off. You've got to be able to cover it so it doesn't get wet. It's such a specialized area. I just think a lot of guys that are in flatbed are what I call lifers. They're in it for the long term. It's their profession. It's their career. But on the other side though, those that are finding it harder physically, it's a very hard physical job. I think some of those guys will transit over to the other areas where the higher pay increases might attract them. But I think, Ned, we've seen new drivers come into the industry at a much higher rate in June. So I suspect all the pay rises that we've seen over the last 6 weeks, they might start to taper off now, given that the drivers are being attracted back to the industry in meaningful numbers. So I'm not sure that there'll be a lot of movement. I think there's just the net new number of drivers coming back in the industry is increasing.
Awesome.
Cool. We only had one question this week. I think it's just a slow week for freight, slow week for questions. There was a power-only question. Have you guys seen anything going on in the power-only market worth discussing?
I'm only talking to a carrier the other day that's doing power-only for JB Hunt's box program, the trailer-only program. They were just happy about it because of the increased volumes. When I say that, the drop and hooks, the quick turns, the higher miles per tractor week. So they were really happy with the productivity levels they were getting out of it. That's about all I've heard though on that front.
Yeah.
Yeah, I mean, that's another thing that's really different from 18 is 18 was mainly a truck and trailer capacity shortage on the truckload side, right? Not every single mode going haywire, right? The only thing I would mention from a power only is there continues to be shortage of chassis as well as trailers out there, so that could be playing a part into impacting power only. I think you're in the most advantageous position right now if you own your own trailer and you're out there running. No doubt about it. Now, to Dean's point, you may be getting more miles and more turns if it's power only and you have a good gig with a carrier. But if you're out there on your own, I think you're better off having a trailer if you're an owner operator right now running.
Ken, the other thing that might be worth chatting about is that we've seen on the Journal of Commerce recently they've been talking about some of the capacity issues that intermodal's having. in particular out of Los Angeles. You've got some of the big railroads suspending services, rationing the amount of slots for shippers, leaving them with very little options other than to transload to 53-foot road trailers and use the spot market. So I think, we're going to see parts of the country under extreme pressure in terms of tight capacity and higher spot rates, given some of the challenges that they're having on the intermodal sector.
For sure. Yeah, it's bananas. We'll see. I mean, we're getting to a retail peak, right? Right. Back to school, for school for real, back to work, back to office, things like that. Hey, so with that, we'll call this an express show. We're under 30 minutes. But like I said, we didn't get too many questions this week. Maybe everyone's on summer vacation. We can only hope everyone's at the beach, relaxing and recharging before we start shuffling around e-commerce freight this fall. Like I mentioned, Freight Find Podcast, Dean's Market Update, Dean's various celebrity appearances on the Freight Talk circuit. We don't have a registration page for it yet, but I talked about it last week. DATCon, so our annual user conference, will be this fall. I don't know if we've confirmed it yet, but the keynote speaker that we're leaning towards is going to be very near and dear to my heart. It should be a really fun, if we can shore that up, it should be a really great experience. And it's always a great time. It's in Austin, Texas. I know that's not going to change. So great barbecue, things like that. And we should have more information for you next week or the week after to get signed up for that. Like I said, it's always a great event, and basically 2 years without seeing folks at the trade show circuit. It'll be nice to catch up and see familiar faces. But with that, we will be back here next Tuesday at 10 a.m. Eastern. We want to thank everyone for joining and hope you have a great rest of your week. Bye, everyone.
Thank you. Bye, everyone.
Bye.